Tesla's stock was down a cool, calm, and collected 2.5% today. This has me thinking about the possibility of an upcoming correction in our markets and how Tesla's stock may react to it. Well, honestly, I started scrolling on X to see and uncover what people are talking about today in financial markets, and you have Michael Burry himself that says maybe it's time for another market correction. Michael Burry, after all, was kind of a one-trick pony predicting the fall of the economy during 2008 and the collapse of the CDOs, collateral debt obligations, and MBS, mortgage-backed securities. And on that note, I mean, he was just short in semiconductors for months and just closed his bet when SMCI was like $1,000 and Nvidia was almost $800. He's got quite a few trades wrong, but it has me wondering, at the very least, when everyone's starting to kind of fear this market to the upside, maybe it could be time for a correction. I mean, Jason Shapiro on X says, can't remember a time when more people wanted the market to go down, ever. And you now have extreme greed back in our markets. This is looking at the CNN Fear and Greed Index. But really, upon any market sentiment metric that you will look at, things just look so good. That's gotta break at some point, right? Well, of course, stocks will always go down, and on average, you have more than one correction every single year. Now, what is a correction? Well, in case you guys don't know, a correction is not a full-on crash. A correction is, in my definition, 5 to 10% downside from highs. So could we be overdue for a correction? Yeah, we're far overdue for a correction. Now, there is one particular date that you need to be watching for over the next 4 weeks or so that will likely cause quite a bit of downside in our markets, or specifically in your semiconductor stocks. But more on that later on into this video. Now, at the same time, everyone is head over heels buying stocks. The corporate insider transaction ratio is extremely bearish. You are seeing selling of stocks like you have not seen in a very long time from corporate insiders. These are guys that are going to have the most clarity on their business, the most friends that are connected to the economy. Let's say Elon, he's gonna know people and talk to people that are connected in other areas. Maybe the Walmart CEO, maybe Microsoft CEO, Nvidia CEO. Well, just for an example, they're gonna have more information than we do if collectively they're like, hey, maybe there's trouble on the horizon. You could make an instance or infer that that could be a reason why they are selling stock. The problem with a lot of insider selling activity is there's a lot of reasons why insiders could be selling stock. To the point I just made, maybe the economy is weakening. Maybe they are the ones that are seeing it first. After all, you know, company insiders would be the ones that would see weakness coming in the economy first. These guys could be getting divorces. They could be buying fancy yachts or new houses. You just never really know. But one thing is for sure, you're definitely not seeing that much buying activity happening from corporate insiders in our markets. And there's only one reason why an individual buys their stock, and that is because they are bullish. So you can make a pretty definitive conclusion that these insiders, they're not head over heels bullish in their companies, right? They're not head over heels super excited to buy as many shares as possible. And they are selling a lot more than what is typically normal. I should also throw in taxes are another big reason why you typically see selling in January, February, and March. 5 hours ago, it was reported that JP Morgan CEO Jamie Dimon just sold $150 million worth of his JP Morgan shares. This is the first time in history he has sold any of his JP Morgan shares. This guy here, I would put him in one of the most connected individuals in the world, as far as economically speaking. More connected than the White House, probably more connected than Jerome Powell, for sure more connected than Jerome Powell. I would put him up there with like maybe an Elon, someone else, you know, significantly important in the business world. but he very well could be the most connected person financially in the world. So when he is selling stock for the first time ever, I mean, he didn't even sell stock during the global financial crisis. Not during the Rona or before the Rona. He's never sold stock before. He's been at JP Morgan since 2003. I mean, I think that sends a pretty ominous signal in and of itself. But then again, you can always justify him selling stock. He's getting older now. He is eventually going to do something else. Why not lock in some profits, at least a little bit? He's still a billionaire. Why not lock in some profits when JP Morgan stock is at all-time highs, then wait to see what happens a couple of years from now when you're actually going to retire or pass the baton off to someone else. JP Morgan also said a couple of hours ago, quote, JP Morgan suggests that investors should consider the possibility of interest rates remaining elevated for an extended period, with the Fed potentially tightening financial conditions. They point out that the recent significant increase of approximately 25% in the stock market since October was based on expectations of the Fed adjusting its stance, projecting more rate cuts in 2024, although many of these anticipated cuts are no longer anticipated, and the stock market has not experienced any significant correction. So basically in English, what that is saying is stocks have went way up recently. Let's be honest, Tesla's not, mid caps have not, small caps have not. Your large cap stocks have, and some of your best pharmaceutical names have done well. These large names have the largest market weighting in the S&P and the NASDAQ. So if you're looking at the S&P and the NASDAQ at all-time highs, hitting new all-time highs today, you're going to say, wow, such a great market. How could you not be making money in this market? But then you look under the surface a little bit, and you see that the percent of stocks above their 50-day moving average, only their 50-day moving average, is 52.5%. Basically, flip a coin, and that's your statistical probability of whether a stock is above their 50-day moving average or not. And again, that is just your 50-day moving average. So if you think about your 50-day moving average, to not be above that, that means your stock has had to have been declining, at least slowly and steadily for the last 50 days or so. Even sideways trading action, you would be right around that 50-day moving average. And again, considering the S&P 500, the SPY, hit a new all-time high today, that's really not a great sign. Now back to the point of what JP Morgan was saying. At the start of 2024, markets were pricing in 7 rate cuts. That's why you've seen an aggressive buy the dip mentality after your 10.5% correction from July through October. Markets S&P fell 10.5%. And then you've seen an aggressive buy the dip kind of activity towards the end of November. And then, end of October, beginning of November. And then end of the year rally kicked in full steam ahead and has basically lasted until now. But back then, we were expecting 7 rate cuts. Now we're only expecting 3 rate cuts. So back then, we were actually pricing in a lot of accommodation from the Fed, and now we're not. So should that, 7 rate cuts getting adjusted to 3 rate cuts in 2024 cause some sort of downside? Probably. And it has. It has under the surface, but not for your big tech names, so it hasn't really moved your headline S&P or your NASDAQ. So 2 things ultimately happen from here. Every single time you get a big divergence between the lower and the mid quadrants doing poorly and the higher end quadrants, like your big tech names, doing well, whenever you have a discorrelation between your highest market cap companies doing well or doing poor and the other parts of the markets doing the opposite, you tend to get a snapback. It's kind of like a coil. When you kind of coil it together, the ends get further apart from where they started, but when you unleash that, it goes back to being a full coil again. So basically what happens from here is the broad markets catch up to big tech, and then you see an even larger rally, or big tech likely comes down and starts to, fall towards where your average stock is. Now, let's be honest. NVIDIA earnings, that was really your make it or break it moment for big tech, and NVIDIA came through for big tech. NVIDIA did fall like 4% 2 days in a row before NVIDIA's earnings, and you see what effect that had on the S&P. It did drive things down from about 504 to about 493 or so. So there was a large impact. Now, there is something coming in the next 3 weeks or so that will have a huge effect on our markets. Potentially start this correction event. But keep in mind, the markets like to price in the possibility of volatility or downside ahead of time, so it could happen sooner. What I'm referencing is the SoftBank ARM lockup period. This is a period in which when a company goes public, CEOs, insiders, people with large investments in that particular company cannot sell their stock for 90 to 180 days after the IPO. Sometimes it's longer, but it's always going to be at least 3 months, at least 90 days. Now, here's where things are crazy. This lockup is March 12th. SoftBank owns 90% of ARM shares outstanding. So what's trading right now is only 10% of the float. The other 90% is locked up. The stock IPO'd at $51. It's currently at $130. If SoftBank wants to, they could liquidate big time. And this could send ARM down a lot. And let's be honest, ARM, NVIDIA, SMCI, these other stocks, it's a lot of trading algorithms that are doing this here. Kind of like recently when SolarEdge came out and gave really bad preliminary guidance before their earnings. The stock dropped 20% that day, but Enphase and Sunrun and all of these other solar stocks also sold off 10 to 20% over the course of a day or two, right? They tend to move in sympathy in the certain sectors. So ARM recently just went up 50% on their earnings. Well, SoftBank just made a ton of money on that alone. Now, SoftBank's ARM position is worth about $90 billion. A little bit more than $90 billion. Could be closer to about $100 billion now since ARM has continued higher after their earnings. Give or take $100 billion or so. Doesn't really matter what the total number is for what I'm about to share next, because this might blow your socks off a little bit. So ARM has done very well. SoftBank made a great acquisition. In 2016, they bought ARM for about $32 billion. $32 billion. When it IPO'd, it was valued at $47 billion. ARM's obviously went up a lot since the IPO. The entire value of SoftBank is $86 billion. So SoftBank's investment, which is ARM, is worth more, or their stake in ARM is worth more than the entirety of SoftBank, the company. That is never going to end well. That's never going to end well. That would be like if, you had a car or something that was worth, let's say a Tesla Model 3 for an example. But someone else had a brand new Tesla Model S or brand new Cybertruck for that matter, and it was worth less than your car, or more than your car technically, but you could buy it at a cheap price. Wouldn't you do that, right? Wouldn't you take something, or trade it for that matter? Maybe that's a better analogy. Take a Model 3, you trade it for a Cybertruck beast, a Foundation. Of course you're gonna do that. Of course. Right? In this sense, of course, SoftBank is going to sell a ton of stock. They were trying to sell ARM to NVIDIA for a lot less than what their stake is worth today. They're going to keep some, yeah. But could they dump 20, 30% of their position? Probably. Now, SoftBank has also fallen on some kind of hard times recently as well. They made a big bet in WeWork. It was the company's most high-profile wager, and that company just spiraled into bankruptcy in November. So, yeah, not good. The Vision Fund, SoftBank's venture arm, posted a $6.2 billion loss in the second quarter of 2023, tied to WeWork and other soured bets. I mean, they've lost a ton of money, so I'm sure they're going to try to recoup some of that. And given ARM is up so much, that's really going to put a damper on the semiconductor space as a whole when SoftBank starts to sell. The question is not, is SoftBank going to sell? The question is, how much is SoftBank going to sell? Are they going to nuke the stock, and is the stock going back to near its IPO price at $51? Or are they only going to sell a little bit? That's really an open-ended question. Let me know what you think down below in the comment section. But that's going to hurt NVIDIA. That's going to hurt SMCI. That is going to hurt other big tech names with AI valuations baked into them. That is all of your magnificent 6 stocks. I would say 7, but you can't group Tesla in that. Tesla has very little AI baked into it, into its valuation, into its stock as of right now. So that is a big problem coming on March 12th. The way the markets operate is everyone knows SoftBank's going to sell some of their ARM stake. Who knows? We might get more details. People might get tipped off on how much they plan to sell. You really never know that aspect of it. But the markets, they're not stupid. People are going to know they're going to sell. So I'm sure that's going to cause a little bit of the air to leave the AI bubble, the GPU bubble, before March 12th. Maybe, once we start March, hard to say, maybe not this upcoming week, maybe next week. That's where I would expect more weakness in the S&P and the NASDAQ. So I think right now, it's only a matter of time before you go through a correction. Because if AI stocks, big tech stocks fall, there is nothing else that is holding this market up. This market is on very weak stilts. If you take out big tech, that's a problem. If you start to, slash some of these AI valuations, that could be a bit of a problem. And again, not to mention the insiders selling stock like crazy. Sven Hendrick, he is a founder of Norman Trader and does go on CNBC and other news outlets to speak a lot about the markets. 400 and some thousand followers on X. He says Bezos, Zuck, Diamond, selling shares, retail is YOLOing calls. That's typically when you're getting to the end of a short-term top. Even Tom Lee with Fundstrat says the market rally is maturing, quote, maturing, and you could start to see some downside. He expects some downside for stocks, a minor correction or so in the first half of the year. So I definitely think you need to mark your calendars for March 12th, but again, the selling could start before then. As the markets already know, SoftBank's going to sell a crap ton of ARM shares. And the sympathy move there is not a question, right? If ARM, let's say, were to drop 10%, 20% in a day, NVIDIA, SMCI, they're going to fall 3 to 5%, if not more for SMCI. I would expect less for an NVIDIA, but still, they're going to fall in sympathy to ARM and vice versa, right? So that's important. Mark your calendars for March 12th. Now, in terms of what this could do for Tesla, I do think your small and mid-cap stocks are a little bit more insulated from, a correction event. I think they have already seen the downside that, could happen to big tech. Not that they won't see downside, but if the S&P falls 5 to 10%, I would expect maybe something similar for a Tesla, but not a 2 to 3 times performance, right? Tesla normally on the upside has a beta of 2 to 3x. On the downside, normally has a beta of about 2 to 3x. So if the S&P and the NASDAQ go up 5%, Tesla should go up like 15%. Now, same thing to the downside. If S&P falls 5%, Tesla can fall, 10 to 15%. I wouldn't expect that this time around. I would expect a closer to kind of 1-to-1 ratio with Tesla. If S&P falls 5%, Tesla probably falls 5%. If we fall 10%, Tesla probably falls 10%. And I think that sets you up in a pretty good scenario. 10% down from here would be roughly about 173, 174 or so, and that's just where you were at back here in early February. So that would be my expectation. I think if we did even go through a 10% drawdown in the S&P or the NASDAQ, you're probably not going to fall substantially more than that for Tesla. After all, Tesla's already down over 22% year to date just to start 2024, when the S&P and the NASDAQ are up like 7-ish% apiece. I think the NASDAQ's up almost 9%. S&P's up over 7% year to date. Now, given that point, I think the markets will start to expect some downside here, maybe trade lower just over the next couple of weeks anyways. We are going to get some data coming out next week that will be vitally important. Keep in mind at this point, the markets want to see good economic data broadly. We don't want to look like we're going into recession, but you don't want to see super hot economic data. So coming next week, just a brief rundown. On Tuesday, durable goods orders will be coming out. You're expecting negative 4.8% month over month. Expecting a big negative number. Now, December tends to be a really strong number, so you got to net that out, and it might not be that terrible, maybe not as terrible as it looks like, negative 5% month over month. You will get the GDP growth rate quarter over quarter, advanced estimates for Q4. It's the second estimate, actually. Expecting this to come in around 3.3%. The previous estimate was 4.9%, so expecting a big downward revision on GDP. Let's say that comes in at 2% or so. Markets are going to say, yeah, the economy is not as strong as we think. Price in more potential rate cuts in 2024. That could be good news for Tesla, but maybe bad news for the broader markets if the economy does start to look worse. On Thursday is going to be your big day. Forget all that other stuff. Thursday is the day. You will get core PCE. Expecting just broadly higher numbers than last month. Across the board, higher numbers. Core, year over year, month over month, everything's expected to be higher. Personal income's expected to be higher. Personal spending is expected to be down. So just not an overall good report is expected on Thursday. That leads me to believe maybe you do get an upside surprise. Maybe things are not as bad as feared, and that could be good for the markets, but we'll have to wait and see. And then ISM manufacturing PMI as well. So this week we didn't have really anything for big important economic data, but next week is going to be full of it. Now I'm going to show you guys some of my trades just because why not? If you guys want to come trade things like this in the trading community, be my guest. Link down below in the description of this video. None of this is a financial recommendation. I am prepared at the worst case scenario to lose all of this money for these trades to go to zero. Now I take risk management into consideration. I like to make options free. I like to get my money back when it makes sense to do so. And I have logics to why I'm making each of these trades. This one is a trade on the S&P 500. $500 puts. I bought 5 of them today, worth about $700 I spent total. They expire on March 8th. So this is really a hedge for next week in case PCE were to come in bad or other data points. Now, PCE is on Thursday. I think the markets are going to be a little bit jittery heading into PCE, and you could get some downside earlier in the week next week, and that would allow me to maybe sell 3 of these, keep 2 for free. That would be my logic behind this trade, or just sell out completely. Currently up less than 1%. I was up a lot more on these at one point. I bought them early in the day today. Almost immediately, they went from $140 a piece to as high as $182. So I was up like 20, well, this was like 35% at one point today. I didn't make them free. That kind of shows you where my head is at in terms of that. I do think some downside is likely imminent for our markets, especially as we are butting up to 510 on the S&P, and that looks like it served as resistance today. The next trade that I made today, that is again something I am fully prepared to lose all of my money in if things were to go sideways. And keep in mind, this portfolio is 30 or so $1,000, $32,000, something like that, and I have almost $9,000 in cash, or $8,500 in cash. So take that into consideration. I'm not putting large percentages of even my cash into these trades, I guess, right? 14% or so of my cash total went into these 2 trades. And I plan to manage risk accordingly to hopefully not lose money unless the markets just keep ripping higher, then I'm screwed. I did buy an ARM trade. Now, this one is very much high risk, high reward like the last one, but I really, really like this trade. And again, be prepared to lose all of your money if you trade this. Just for total transparency's sake, I want to share these with you because I think right now is potentially a good opportunity to hedge portfolios depending on which way you're looking at the markets. Currently, I'm up 26.32% on this trade. I made this today. I bought 30 ARM $55 puts. Keep in mind, ARM IPO'd at $51. I'm not expecting these to go in the money. I'm not expecting ARM to fall to $55 per share. So I think if you hold these to expiration, if you play this, you'll lose all of your money. These are for April 19th. So what this play's logic is essentially if coming March 12th, which is not next week, not the week after that, but the week after that, the week of March 15th, coming by then, you're probably going to get some downside in ARM, at least. And when the lockup period actually ends, you're probably going to get even more downside. That's why I went an extra month out. Because if ARM, let's say, drops 10, 20% in a single day, if you have a month more of contracts or a month more of time, the contracts are likely going to juice higher. I wouldn't be surprised if these contracts go to $200 a piece, just based on, let's say, the time premium if ARM were to fall to $100. People are going to get fearful, especially if the markets are falling at that point. People are going to go out and look to buy protection. These things are 58.5% out the money. I'm playing a potential rise in implied volatility and essentially premiums that could come to these. And I bought them on a day where ARM is up almost 3%. So got a pretty decent overall price on these. So it's a very specific strategy that I am actually employing here. And I bought these for $19 a piece. I spent $570 on this trade. This is another high risk, high reward kind of trade. There's more time, so I feel more comfortable in this one than the other S&P one. That is really, going to be more stringently monitored. But I do think the downside is inevitable here and likely just in the broader markets as well. The premiums make sense right now for downside protection. Let me know what you think about this information down below in the comments section. If you guys want to come trade some of these different trades with us live in real time, every time I make these kind of trades, I send out alerts. Link down below in the description of this video. In the meantime, hit the like button as well as subscribe to the channel. Let me know again what you think about this information. Thanks for watching. Enjoy the rest of your day and your weekends, and I will see you in the next one.